Welcome to the Value Investor TV podcast. This is the podcast to help you grow your wealth and become financially independent. My name is Becco and my partner, Hari.
Hello.
This is episode number 2 for WEX, a continuation of our discussion around the company, specifically about its financials, its management. I'm happy that you guys are here with us. Hari, could you give us a disclaimer before we start?
Yeah, so this is the Value Investor TV podcast. We are a podcast that educates you on the concepts behind value investing. We do not make specific financial decisions or give you financial advice. We are just here to educate you. If you have any need those services for financial help or tax help, please consult with the appropriate advisor before making a decision.
Great. All right. A few housekeeping items you want to touch on really quick, Hari, for us?
Yeah. So, this company, WEX, was brought to us by a trusted listener who asked us to analyze it. If you are interested in having us analyze a company on the podcast, you can send us an email, info@valueinvestor.org. We also use this checklist to help us guide our decision-making and make sure that we don't miss anything when we evaluate companies. So if you'd like a copy of that checklist, you can also email us at the same info@valueinvestor.org. And then the last thing is that a lot of our listeners join our Slack community. Slack allows us to keep in touch with you on a more frequent basis than just the podcast. You can send us messages, and if either Becco or I are awake, it'll ping us on our phone, and we can answer you directly. So we are happy to do so. And in addition to that, there's lots of other people in the community who can help you with finding resources or pointing you to other YouTube videos or anything else. So please ask for that on info@valueinvestor.org, and we'll be happy to add you to the community.
Great.
Okay, Becco, so we were talking about WEX, and we had talked about the company, what they did, and what moats that they potentially had, and some of the growth prospects. So now we're going to kind of talk more about their return on equity and their ability to take that moat and translate it into a high return on capital. Amongst other things, the other things we'll be talking about are management, debt, and other financial things, and finally the valuation. So let's get started with that first question. The return on capital or return on equity is a measure of how profitable a business is. And a high return on equity businesses are things that we like to invest in as value investors. So what do you think about WEX's ability to take their moat and translate that into a high return on capital?
Yeah. So I think, just a side note, I think this is one of the most important questions, aside from the competitive advantage question, to be asked in terms of analyzing companies. I think Warren Buffett, released the annual report, and his letter to the shareholders, he talked extensively about that. So going into this question, there are a few things that you can look at to answer this question. So return on equity, as Hari mentioned, that's one. Return on asset, you can look into that. You can look into return on capital employed, ROCE, and then ROIC, return on invested capital. You can look at all these different measurements and metrics to figure out if the company is returning good money on the base capital. So for a company like this, where the debt, as we mentioned in the previous episode, is non-negligible. In fact, it's actually quite a bit. If you look at return on equity, it will skew the number to be more favorable because you're looking at the equity portion, and that portion doesn't really account for the debt. right? So if you look at equity, it's standing at around 10%, 8 to 10% recently. But if you look at your return on invested capital, for example, it's around 5%, 5 to 6%. Return on capital employed, it's standing at around 7%, 6 to 7%. If you look at return on asset, it's about 1%. And so I think more accurate measurement of this kind of um, business because of the debt level is more. I think what's more appropriate is return on capital employed or return on invested capital, and the number is around 6 to 7%.
Okay, so that's terrible, and and is really not something I have any interest in, right? So
Yeah, right.
so let me just, so our listeners are, we will continue to talk about this company, but um, when you get to a checkpoint here, remember, you don't need to fully understand every aspect of a business. If you see a red flag or something like that that makes you not want, you can just stop, right? Because your time is also valuable. It makes sense to look at another business. So if I have a business that returns 5% on a return on capital basis, and I have another one that has 15%, well, the 15% business is the one I want to own, because they can translate their money, every dollar they invest, into a higher amount of money that I get, right, as an investor. So, with that being said, 5 to 10%, depending on what metric you use, is terrible, right? That's roughly. I would be better off investing in in an index fund, right? And I would get a better return than if I did this. So, we'll dive deeper into this, and maybe we can explain why their return on capital is so bad. But it's really not that good, and it's not something, I would want a minimum of 15%, and really, the higher the better. So, but this one makes me think that there's not a lot for me from a competitive advantage standpoint that makes me want to invest in it. So, okay, so let's move on from that question, because I think there's going to be more educational stuff when we get to the valuation aspect of it. So I'm not gonna dwell too much on these, but let's talk about them real quick. These two questions. Do they have enough cash to maintain their business, and do they maintain a reasonable debt level? I think we've already talked about the debt part of it, but go ahead and give us some information here.
Yeah, let's talk about the debt level, and then we can talk about cash as it relates to debt. So if we look at the debt itself, let's start from the top of the financial report. So income statement. If you look at the amount of money that they're paying out due to interest is around 7%. It is above 7%, so it's close to more 8%. And if you look at the trend there, and as I mentioned in the previous episodes, there has been a string of acquisitions, and a lot of it has been funded by debt. So if you look at that, if you look at the trend of that percentage, so percentage of interest payment per revenue, starting in 2012, it was at around 1.6%. So pretty negligible in terms of the interest payment itself. But now it's almost 8%. So that's first in the first financial report in the income statement. If you go towards the balance sheet as well as the cash flow statement, and you look at the percentage of debt to free cash ratio, and you want that number to be around 3, which means that you're able to pay out all the debt with free cash flow within 3 years. Right, that's what that means. And so you want that ratio to be under 3. Right now we're talking about last year it was 7. The year before that, 43. 2015, 3. 2014, 5, etc. So you got anomalies here and there, but overall it's not looking very good. in terms of that ratio, that threshold that we want to stick to.
Okay. So, I mean, at this point, I think a lot of people will say that they're not interested in this business, but because we're here to entertain you, we're going to plow through the rest of this thing. Um, so, let's talk about that free cash flow and, do they generate a strong amount of free cash flow from operations?
Yeah. So free cash flow, they're generating about 300. There's obviously fluctuations, periodic fluctuations, but you're looking at somewhere around $300 million, a little less than 300 million. But if you also look at what's going out as capex, it's around 21%, 20% of net cash flow from operation. So you make $100 million from net cash from operation, and then 21 million of that is going back into the business as capex. And so you're left with 80 million as free cash flow in that scenario. So that's something quite notable, because you would imagine, right? I mean, this is a software business, right? So in terms of capex, high capex business tends to be heavy industrial with lots of upfront investment in terms of infrastructure and things of that sort. I didn't expect this from a software business, mainly software business. Obviously, there are some parts that isn't software, but it was kind of notable for me.
Okay.
What is your thought around that, Hari?
Well, I mean, I think it is kind of strange that you would see that. I feel like this business is really not managed capital very well. When they're buying new businesses and then eroding their own margins, that to me is kind of like they're desperate to get into healthcare. Healthcare turned out to be kind of a disaster from a margin standpoint, and it's not really benefiting them for being in it. So, and we're seeing that a profitability for this business is eroding because they're also spending more money on businesses that are not adding a whole lot of value and loading themselves up with debt that will take them a long time to pay off. So
Yeah.
I'm not really thrilled, with this, and I question also, like, what is the value of this of a business like this, because they're generating cash flow, but they're spending a lot of money to acquire growth, and that growth is not really panning out, and yet at the same time they have, I don't see a lot of turnover in their management or anything like that. So why don't we talk a little bit about management too, because then I think we can see how under or overvalued this business is relative, even though we may not necessarily be interested in it. And that may guide us a little bit more about, if this company went on sale, it doesn't sound like we'd still be interested in it, right? That, from a long-term standpoint, it's not a great business, whereas there are plenty of good businesses out there that are too expensive, right? So we've already eliminated this company as almost an investment vehicle, but then it's now a question of what is the to do the exercise and complete it so that we can learn from this company. So let's talk about the CEO, Melissa Smith. I find it interesting that she has been there since 2014, and it sounds like that's when they started acquiring businesses. So
Yeah, exactly. It's I mean, I think it's interesting, right? I mean, the CEO, Melissa Smith, she's been around the company for a long time. She joined in 1997, I think, as an analyst or something.
Mm-hmm.
And now she rose up the ranks to CEO in 2014 and became a director as well in 2014. And so I guess one good part of this is that, I don't know about her financial background or her husband's background or what have you, but her wealth, her substantial wealth, is probably locked into this company. Obviously, she might come from money, things like that, but it is a good sign that a substantial part of her wealth is probably locked into this company. And if you actually look at the numbers, the amount of shares that she owns about $33 million worth of the company, which is not a lot, but still, it is notable.
Yeah, and I think the as a shareholder, I would not be thrilled with her performance over this time period, right?
Hmm.
The best way to measure a CEO's performance is how much more money am I making as a result of their initiatives, their plans, their strategy, and so on. And I don't even really want to spend too much time on the management side of this house because I think they've done a terrible job. So, you're eroding your business, and so I want to move on, right? As a person. So I'm
Yeah.
not gonna there's a lot of detailed information you can get from the proxy statement, which tells you how much money someone was being compensated for, and so on. And I would tell you, if you're taking my money and getting me a 5% return, then I'm not interested in your services as a executive. Uh, so maybe it's time to move on and get somebody else. Uh,
Yeah.
so let's move on to the final part of this, which I think is going to be the more interesting thing, which is walk us through what your valuation is for WEX, and tell us the assumptions that you made, when to come up with that valuation.
Yeah. I think just to reiterate Hari's statement and his sentiment around this company and the discipline of going through the checklist, we have a few points above this. We have already made the judgment that it is not a viable vehicle in terms of our investment. But just for the entertainment purposes, like you mentioned, Ari, we'll go through this. We use discounted cash flow to calculate the intrinsic value of the company. So what that means is we project out into the future how much cash this company will generate, and we discount this cash that was that gets spun out, or I don't know what the right verb is, but the amount of cash the company generates in future years, we discount that back into present time, and that's how we calculate the intrinsic value. So if we start with the free cash flow of about $300 million, and I assigned the growth rate of about 7% for the first 3 years, and then 5%, and then dwindling to about 3%. Because you look at return on equity, return on invested capital, it usually just matches that, and so I put it there, the terminal growth rate about 3%, and you discount it by 10%, and that's the discount rate that we've been using as a minimum threshold that any investment has to clear. So you look at that, you look at the shares outstanding and the cash on hand, and you get about $77. And right now, the share price is, the companies are trading at $230 per share.
Okay, so that sounds like they're pretty expensive relative to their, the valuation that you're coming up with at $77 is not even the price that we would want to pay, right? We would want a buffer between that called the margin of safety. So, and that's typically around 50%. So, we would want it to be under $40 a share before we would be interested in this as a business. And I mean, I agree with you that, this is an expensive business. They don't seem to be handling shareholder money very well with acquisitions that are returning lower and lower rates. So the real question is, let's say that this company tomorrow dropped to $40 a share. We still may not be interested in buying it. I mean, do you agree with that sentiment?
Yeah, I mean, I think also this is important coming from a value investor standpoint, where we want to buy quality business, kind of channeling Charlie Munger's ethos here. So yeah, I would agree with you on that.
Okay, and I mean, I think the thing that is interesting about these guys that we kind of touched on a little bit is their free cash flow and their earnings per share are somewhat different, due to the fact that they've made a lot of acquisitions, and the acquisitions that they have in the healthcare business especially have intangible assets, which have been amortized, which means that they are discounted against the income. So what you're seeing is a discrepancy of the earnings from the income statement, the net income, and the free cash flow. And so when you look at it, you'll see a price to earnings of like 60. But this business is actually being evaluated based on their free cash flow, which they call in their annual report adjusted net income. So that's a non-GAAP measurement, and a lot of companies have been doing this. Right? They take away their earnings. They do an EBITDA or something similar to that, right? So I think from our standpoint, sometimes those valuation metrics are okay to look at, right? But generally, depreciation and amortization are real expenses, right? And they should be something that you take into account as you evaluate a business, because that money has to be repaid. That depreciation of an asset has to be repurchased at some point, right? And so looking at this, if there's big discrepancies in it, there needs to be a reason why. And that reason why is something that you have to account for when you evaluate the value of a business, right? And so businesses that have some sort of hybrid financial component and a retail or other type of component, they sometimes have these discrepancies in what is considered free cash and earnings per share. And in this case, I don't see it as being a red flag, but I do think that there are other red flags in this business. So
Yeah.
what are your thoughts, Becco?
Yeah, I agree. I just want to channel Warren Buffett. I read the letter to shareholders today, and I think there is a paragraph in there that's actually quite pertinent to this discussion. So let me just read it out to you. In the paragraphs that follow, we group our wide array of non-insurance businesses by size of earnings, after interest, depreciation, taxes, non-cash compensation, restructuring charges, all of those pesky but very real costs that CEOs and Wall Street sometimes urge investors to ignore. So I think it's a obviously it's coming from the Oracle himself. There's a lot of wisdom there, but I think this was a pertinent to kind of add to the discussion that we just had.
Yeah.
Yeah.
All right. All right.
Yeah.
So I think the in the coming weeks we're going to be talking a lot more about companies, evaluating them for various different things. If you are interested in having us talk about a company that has some interesting properties or is something that you'd like us to look at, we're happy to do so. You can send us an email, info@valueinvestor.org. Or if you're on the Slack channel, by all means, send us a message on general. And if you want to be part of that Slack community, just send us an email, info@valueinvestor.org.
Excellent. Thank you so much, guys, for tuning in. We hope to see you on the next episode.
Yeah. Thank you.